All right, welcome back, everybody. My name is Patrick from Prime Ag. Thanks for tuning in. We've got another webinar here. This week, we are going to follow up on the bean put recommendation that we put out as part of our educational marketing series. I know we talked about buying put options in the past, and we just wanted to kind of wrap it up and show you here now that the November contract has, the November option has come off the board here about a week ago Friday. We just wanted to show you how things worked out and what the thought process was as we went through making this bean put recommendation. So what we did here is we recommended buying a $13 November 21 bean put. That was on May 12th. We put that on our report for about 30 cents. Keep in mind commissions on that for us is like a penny. And then obviously everybody gets a little bit of a different fill. So we're going to go with 30 cents for easy math. Why did we decide to make this decision? Well, we had made some cash sales on the rally up, and we were trying to, respect the continued bullish narrative and the bullish move out there. But we also needed to have a line in the sand as far as what level we wanted to protect with profitability if the markets were to wash out. So things looked a little bit extended on the charts, which we'll show you on here on the next slide, and that kind of helped in making this decision. The other thing too is, we take phone calls from farmers all the time, and what we heard, where guys were worried about how many bushels that they were going to raise. Things were a little dry in the U.S. We'd come off of a big run. Guys were already kind of cash sold. They weren't really interested in making more cash sales with the possibility of the markets continuing, to push into the 15, 16, maybe even the $17 range. And then, of course, South America was there were some rumors about them having some crop issues. So, we respect all of those thoughts, and that's what goes into the decision-making process, of why we chose to do a put instead of a cash sale, to give guys a little more flexibility. So, again, just to recap, what would happen here at 10:22 on option expiration. If the market was at 16, we spent 30 cents for the put, you'd end up with a net futures price of $15.70. We thought that's pretty good. On the other hand, if the market was down at $12, you've got that $13 put, you spent 30 cents, so you would net out at a $12.70 futures price. And again, that was an area that we could live with, if beans were at $12 or much lower in October. Now, remember, we made this decision on May 12th. This was about 5 months prior to expiration. So here's what the chart looked like on that day. You can see beans had made their run up. Like I said, we had made some cash sales on the way up, rewarding the rally. And then, look to the option board, like we said, because one, guys were a little concerned about what the production was going to be. And number two, this is a pretty good rally, a good run, and we wanted to leave the top side open. And we felt, again, the put option is the best way to do that. So you give up a little bit by not making the cash sale, but on the other hand, if the market runs higher, you get to stay on board with those bushels. So this is the chart on that day, and what we were looking at, you can see that we've got a little bit of an extended bar in there. So things were kind of a little bit of a warning sign that maybe some action should be taken in the market. Fast forward to June 8th. Here's the drought monitor again, kind of a valid concern of guys. You can see that there was definitely some dryness in some key soybean areas. So, all warranted reasons to get these puts in place and be cautious of making additional cash sales. So here we go. That spike high, the new spike high, was June 7th, and then the drought monitor came out on the 8th. Okay, and then this shows basically a month from when we bought that put. So up until June 11th, things are again showing a little bit of a warning sign. Market's looking a little bit extended. The blue line's where we bought that put back on May 12th. So this is what we're looking at. You got to say to yourself, when you're sitting here, is this thing going to push higher or is it going to break lower? This is a sign that the uptrend is at least paused for the momentarily. And now here's the complete picture of the chart played out into expiration. So again, that blue line, that's where we bought the put on May 12th. Green line there represents the put strike price at $13. Your contract high, which is clearly visible now, 3-4 months removed from that date, was $14.80. We made the decision to get these puts on when the high of that spike bar was $14.60. So about 20 cents. That's good enough for us. Not the point of this video though. In fact, the major point is, guys worried about 20 cents, they need to be worried about the next $1, $2, $3, $4 move. Because as you can see, as we work through the course of the year, beans continued to show weakness and finally broke that $13 level down into expiration at 12.20 where they finished. So guys showed a gain in their hedge account on these put options. However, keep in mind you did take a loss on the physical bushels that you didn't sell by holding the put, but that's what it's there for. It brings you back up to that net price. So again, these are kind of the points of decision making and what the thought process was as we, went through recommending these $13 put options. Another quick chart in here, that little box just represents, this is something that happened to work out this time, that with about a month until expiration, beans were just below and kind of hanging around that $13 strike price. So the option premium was showing a little bit of profit for guys that were able to buy it, in the 30-cent area. So, as brokers, we were able to talk to some, guys that were more comfortable with their production, were willing to make a sale here and close out of that put option and got closer to a $13 net futures price rather than, holding all the way through and getting a 12.70 price. So again, this doesn't work for everybody. We just are trying to illustrate the point that you don't need to hold these options all the way until expiration. In fact, on any of those previous run up moves up, you could have easily offset the put option and sold the cash if you were comfortable with your bushels, and things of that nature. So again, just trying to illustrate the full the range of flexibility that you have when using these put options to protect revenue. So just kind of to wrap things up in here, marketing, and as you can see, as we use the charts more in real time, if you will, there's a lot of mental things going on here, and we always have to ask ourselves, and we encourage producers to ask themselves, what are your margins? How's profitability looking? What types of things can I live with if I don't make a cash sale here because I'm concerned about my bushels? What am I going to do if the market goes down? What am I going to do if the market goes higher? And also focusing on what is going on right now. Again, kind of a major point of this video and why we showed you, the day that we made this decision with only the chart showing up into that day is because it's very easy to go back and hindsight things. But when you're making these decisions in real time, that's all you can work with. You cannot predict the future. So, find 2 or 3 things to focus on when you're making your marketing decisions. There's a lot of noise out there, and it's certainly easy to go back and wish you would have done something better. But, I think the right way to go back on a chart is to cover up the right side and go back to the day you made a decision and say, what was going on at this time to influence my decision. So, and then again, just a quick reminder, there's always opportunity cost on these puts. By buying the put, you gave up selling cash, potentially at those higher prices. But again, that's okay if you're not comfortable with where your bushels are at or things of that nature. So there's always going to be something lost for something gained. That's just the way it is. The other thing we like to point out is, have a broker. This is something that we bring to the table. Farmers, obviously are busy. Summer months are busy for guys. Emotions are running high. It's always good to have another set of eyes and even a contrasting viewpoint. Everybody was pretty bullish at this point. Some cash sales were made on the way up. Some guys think that they were made too early. Some guys did sell too early. Whatever. It's good to have somebody else to say, look, let's stick with a marketing plan. Let's find some flexibility in our marketing plan. If I'm hanging out with 10 guys and everybody thinks the bean market is going to run higher, I need to find the 2 guys or 1 guy that says, here's why I think it's going to go lower, or vice versa. Maybe you're hanging around 10 guys that think the bean market's going to go lower, or whatever market. Find a broker or find somebody that's going to say, hey, I think this is going to go higher, and give you a reason, or a contrasting viewpoint, just to show, some potential blind spots. And then again, we hear this all the time, guys don't make money on options and this and that. And we don't want guys to be confused. This time, if you held your option all the way through expiration, you did in fact show a gain in your hedge account of about 70 or 80 cents. What you have to keep in mind is if you didn't sell any of the bushels that you had hedged, you lost that same 70 or 80 cents on those bushels. And again, that's okay because you have the hedge in place. But we just want to make, help guys understand that it isn't necessarily about winning or losing in the hedge account when you're specifically hedging. These are good tools to have. Find yourself a good broker or somebody you can work with and talk to, and don't be afraid to to use these positions as you go through the year, or ask questions on them. And things of that nature. There are no dumb questions. There's a lot to learn, and a lot of changing situations as you go through the marketing year. So anyways, if you found this video helpful, if you learned something today, please like the video, subscribe to our channel so you'll be notified when we post new videos. We do try and we do one at least once a week, sometimes more than that. If you guys have questions, if you need to open a brokerage account, if you want to talk to a broker, email us admin@prime-ag.net. You can always give us a call, 800-211-1757. We're here to help you out, help you make decisions, and we look forward to making this next video and seeing everybody again soon.